So today the Federal Reserve is going to meet and announce a rate hike at 11 a.m. Pacific Standard Time or 2 p.m. Eastern Time. So I'm going to go ahead and start sharing my screen, and we're going to watch the market react to this overall report. So very, very excited. Pretty high expectation that the Federal Reserve is going to pause once again, because economic data has not supported the idea of a potential rate cut. It's what we were told that in 2023, as we're coming into the end of the year, that 2024, they had 4 potential rate cuts prepared. But now we are going into the month of May. There has not been one rate cut, and it's because inflation is actually not going down anymore. It's actually going up more than what was originally expected. So NASDAQ market is currently down about 0.5%, nothing too significant. Market's been very, very choppy. It tends to do this anytime right before a major economic report. And I wanted to share this with you guys as well, just so you guys all have access to it. So again, this is the Fed Rate Monitor tool. This tells us or gives us a better understanding of what the market's expectation is. Again, this is just the forecast. No one knows exactly what it is that's going to be reported. But according to this Fed Rate Monitor tool, according to investing.com, there is a 96.5% probability that the Federal Reserve is going to pause and a 3.5% probability that the Federal Reserve is going to cut. All right. Let me go ahead and go back here to the NASDAQ market. We're testing the same previous resistance that we have in the past before. Okay. Let me run a quick little poll. So if you guys... Sorry about that. Okay. So we got NASDAQ testing the same previous resistance. We have SMCI returning back to previous lows of 700 is what we hit lows of today, 700. Right now we're down 14%. So it's great to see that SMCI is finally pulling on back. It's been an overhyped up stock for too long. And finally it's catching up to that BS of what it was, what people were factoring in versus what it actually reports. So I'm happy to see that. Hopefully some of you guys made a ton of money shorting that crap stock. We have Starbucks that is down 17.4%. So 17.4%, consistent lower highs, lower lows. Tell your girlfriends, tell your wives, Starbucks is having a 20% discount, not in store, but in Wall Street. Check that out. All the way back down to almost previous lows where we were back in 2022. And yeah, I have AMD as well. AMD wasn't down as much the last time I checked. Yeah, it's down 8% all the way back down to the moving average. So it ran through some of the hype of AI when all this AI hype was being present. And then it's been selling off ever since then. Lower highs, lower lows, and that's exactly what we're seeing. But now it's a little bit more on the oversold side. So let's just be careful of that. So, all right. What else do we have? DJT finally pulling on back, even though they're blocking the ability to short it. It's down 8.33%. A little bothered that I'm not able to short that crap stock. Would love to short that thing on the way down. We have Snapchat looking overbought as heck, but guess what? It is not pulling on back. It ran up about 28%. It became very overbought, and guess what? It's still trying to push up. Its overall true direction is extremely bearish, at least it was. We'll see if when it goes back to previous highs, which is right around 1750, if it tries to hit that previous resistance, if we end up getting rejected again and then selling right back off. So it's 2 a.m. in Amsterdam. Wow, that's wild. Oh. I mean, I believe it. I was there in Amsterdam. It was hard. It was hard to be over there and trying to keep up with the market, because like the market opens at like 2 or 3 in the afternoon, right? Is that not correct? It was something like that. I think it's like 8 hours ahead or something like that. But yeah, and in Amsterdam, again, I was completely unaware of this. I'm Mexican, so it caught me by surprise, but there's a bunch of bikes in Amsterdam. We obviously stayed in a very touristy spot, but man, I've never seen so many bikes in my life. But yeah, it was cool. It was a cool experience somewhat, right? Okay, we have 7 minutes left until this FOMC rate decision is actually announced. So it's 1:53 a.m. here in the Philippines. Wow. Well, I appreciate you tuning on in. Thank you again. Thank you to everyone that tuned into my previous video and dropped a thumbs up. You guys got it to 1,000 likes super quick. Hopefully we can get this video to 1,000 likes. I love hosting these live streams when you guys like that I host them, right? And all I literally ask you to do is drop a thumbs up and subscribe to the channel, and I'll continue to show up and host these little live sessions so we can watch. I mean, trading can be very lonely, right? I don't know about you, but I'm always just sitting in my office watching candles, and it does get pretty boring. I mean, we have our LPP team, so that's great that we're able to engage with that group, but even then, it's just, still a Discord chat. So it's always great to be able to go live and to have conversations with you where it kind of humanizes it a little bit more. So yeah, love from India. I appreciate that. Thank you. 7:54 in Italy. I like that. Have some pizza for me. Pizza's like one of my favorite dishes. 500 likes and Ricky gives away a prize. How about 1,000 likes and then I'll give away a day trader mouse pad? Does that sound fine? An extra large day trader mouse pad to one of our, and everyone can like it, but let's be fair. The day trader mouse pad's only going to go to one of our beginner traders. So if you guys ever head on over to shoptechbuds.com, we have a full mouse pad collection. Let me pull it up. But I want to give away the Big Johnny, the day trader extra large mouse pad. So yeah, let me make sure it's in stock. Yeah, we have it. So yeah, 35 inches by 15 inches. Sweet. We'll see. We'll see at the end of it. If you guys get the videos. What's going on, Miguel? What's up? Can you make the Formula 1 mousepad extra large? You like that one? I know it's dope, huh? This one? I thought it was. No, it's only 23. Yeah, I'll talk to our team about it. Don't quit your daydream. It's probably one of my favorite. I mean, it's very vibrant, so definitely not for everyone, but it's nice. I mean, it's bright. I like it. So I'll make sure I bring it up to them. How about that? How about I just let the winner choose whatever mousepad they want instead of me choosing what mousepad they take. So whoever I end up choosing, I'll do a little poll at the very end, and we'll pick someone at random that participates in the live chat. You do have to be subscribed to participate in the live chat, so just a little heads up on that, okay? Just another reason to subscribe. So what is the Fed going to do? Let's run a poll real quick. Rate pause or rate cut, because the idea of a rate hike is not very likely, so I'm not even going to put that. There it goes. Okay. Cool. How many of you do we have in here? I don't even know. 3? Just kidding. All right, 1,600 of you, 1,500. Sweet. Hopefully we earn your thumbs up. So for those, very quick, we have 3 minutes left, a little bit less than 3 minutes, almost 2 minutes left. Let me explain this very quickly. For those that are tuning on in for the first time, first off, thank you. Second, it's a very risky time to trade. That's the first thing that I want to share with you. You probably don't want to trade today. It's more for you to watch. That's kind of the way that I want to approach this. I wish I was told this when I first got started, okay? The second thing is, how does this all work? So in 2 minutes, the Federal Reserve is going to announce either a rate hike, a rate cut, or a rate pause. And the market's going to digest that data. So what that means is the Federal Reserve is either going to cut or pause interest rates. If they cut interest rates, most likely the market will skyrocket. If they pause interest rates, it's kind of already expected. If they hike interest rates, get ready for the markets to drop. Now, 30 minutes after the rate decision, Jerome Powell goes live and he begins to answer questions from journalists. So you're going to see like the Wall Street Journal, the Huffington Post, all these different people there. Some of our favorites, right? And you guys will see. It's a very animated group that we have here. And it's much more fun when you watch it with other people. Now, let me be open with you. It is quite boring, especially when we get into kind of more of the redundant questions, right? Jerome Powell is a pro at this. You can say what it is that you want about him, but he's very clever and he's very specific. He does not say too much without, even when he's asked very specific things. He's very well scripted, and some people like to call him a puppet. He knows his role, and he knows that what he says, if his sentiment is a little bit different, it could influence the market in a good or bad way. So he tries not to say too much, and I respect that. In 30 seconds, we are going to watch the market digest this data, and then we're going to see him 30 minutes after answer questions from journalists, okay? So let's go ahead and see which way the market goes. We have a 90% probability that the Federal Reserve is going to rate pause. Let's see which way it goes. We have 15 seconds. Let me know in the live chat. What are we doing? Pausing, cutting, raising. Here we go. Let's do a countdown. Ready? 5, 4, 3, 2, 1. Boom. Let's see. This is NASDAQ. QQQ is NASDAQ. Let's see what we get here. It's rising. Okay. What do we got going on here? It's another pause. I don't know why that's a surprise or why that's reacting in a positive way. Watch for a fake out. We've seen a lot of fake outs lately. A lot of bull traps. Do not get caught on a bull trap. Remember, this is not the time for beginners to be over trading. It's a very volatile time to trade. So I'm just making you aware. At the end of the day, you're an adult. You can do whatever it is that you want. Yeah, they paused interest rates. No, and NASDAQ market is trying to recover. Look at that. So they stayed the course. They are pausing interest rates. That wasn't a surprise. There was a 96% probability that the Federal Reserve was going to do that anyways. I do not know why the market sees that to be a positive reaction, but hey, a lot of the things the market does doesn't necessarily make sense. I almost want to short it. Dang it. I was going to buy into SQQQ. I might. Let's see if I get it closer to $12. I'll do it. I think it's an absolute joke that it's trying to react in a positive way when we all know there's nothing positive about what it just announced. And if it gives me my 1205, I'll take it. And it's not much. It's just 1,000 shares. It's about $12,000. Short TQQQ. I don't care to short TQQQ when I can go into SQQQ. Waiting, and that's also another thing that I want to share with you. I'm really glad that you brought that up. The market can react in one specific way once this, the report was just released that, okay, we're going to be pausing interest rates. But when Jerome Powell begins to speak, a lot of the times, not always, nothing is 100%, but a lot of the times, how many times have you seen this if you've ever tuned on in? A lot of the times when he begins to speak, there's an opposite reaction. So although the market might have reacted in a positive way, as soon as he begins to speak, it might just create a wall of selling pressure. I don't know why. Again, it's just how the market likes to react. The market moves. It's kind of like an earning report and then the guidance call. Two very different moves. Okay? 1208, not low enough. Do you see it reaching 13? Chaps, what are you talking about? Are you asking me about SQQQ? That could I see it reaching 13? Is that what you're asking me? It was at 13 just a few weeks ago. Why couldn't it? Do I think that the market's extremely bearish? Not extremely bearish. But one thing that I do want to point out is we kind of have these descending highs, right? So it sells off. When it goes back up, it doesn't go as high as it did before. It sells off. It goes up. It didn't go as high as it did before. So that's not the best. It's not the best kind of like pattern because it's a descending pattern. Lower highs, lower lows. What's going on, Carlos? I appreciate that, man. Thank you. DJT. Not much going on there. We got Snap. Snapchat trying to break above that $16 resistance. Tesla trying to recover. See if we get it. I'll buy some. I'll stay light for now. 500. Sweet. 500 shares, which is about $6,000. Just a little heads up. Please do not copy. I've been wrong many times, and just because I choose to take a trade does not mean that you need to. Just because I can tolerate some kind of risk does not mean that you should. Okay? Please make sure that you are aware of that. So NASDAQ market right now is testing its resistance. Let's see if we break out. I like the setup here. Nice push. Still a descending pattern, but I'm just averaging up into it. Thanks for the live stream. I appreciate you tuning on in. Thank you. Hopefully we earn your thumbs up. I like that. So someone just shared in our Discord chat for LPP saying that the Fed does not expect it will be appropriate to cut rates until it has gained greater confidence that inflation is moving towards 2%, which is great. And they're saying that we might not see the first rate cut until November. I don't know how true that is, but that's not good news for the market. That means that if we expected 3 to 4 rate cuts and we're not going to see the first one until November, how does that do? How is that positive news? It's not. I'm going to buy into this a little bit more. And again, please do not copy. This is me choosing to take the trade. All right. Can you bring up JP speaking? He doesn't speak until 23 minutes from now. He doesn't speak right now. Going long on Tesla. Good luck. You are buying SQQ. That is what you saw me buy. Yep, that is correct. Testing previous support range. Overall NASDAQ market. Yeah, none of this is good news. Every statement that I see from today's FOMC rate decision, they're stating that they're not even close to cutting interest rates. So how could the market react in a positive way? Beyond me. That's the head scratcher. Oh, there it is. I was looking for dang NASDAQ. Here it goes. NASDAQ trying to hold its support. I'm ready for this. I am ready for this. Markets just want there to be any reason to go up. Yeah, markets find there to be any reason. I mean, why even wait for the... That's the part that baffles me. Like, this report did not support a bullish move. So why even wait for the report to come out to then react in a bullish way? It's really just to fake people out is almost what it feels like. But we'll see. Again, truly no one knows. No one knows how the market's going to digest what Jerome Powell says today. He might come out guns blazing. Have you guys seen that meme? My buddy Justin sends it to me all the time. I think we've posted it on TechBud Solutions Instagram. It's like when Jerome Powell's like walking out, and when he's about to like just say, he says his first word, and then all of a sudden markets just begin to like drop or completely skyrocket. Have you guys seen that? It's truly what it feels. I feel like Jerome Powell, who's the head of the Federal Reserve, for those that are a little bit newer to the market, I feel like his word, his comments, obviously him being in charge of monetary policy, are so much more important to the stock market than anyone else. Any president, I don't feel like I've ever heard President Biden say anything that has been that significant to the way that the market reacts. Also, I'm not breaking down any stocks right now. So if you want me to break down your stock, you can ask me during our live trading session with the LPP team, or you can tune on in to our Sunday stock talk if I end up hosting it this Sunday. But if not, again, you can ask me in the morning during our live trading sessions, and that's that second link in the description down below if you want to tune on into our live sessions. If not, I respect that. That's fine. But as of right now, my main focus is only covering what it is that I'm trading and answering general questions. So here it goes. Beautiful pullback. Bingo! Come on. Drop it like it's hot. Come on. Come on. Come on. Him taking a breath moves the market. It feels like that sometimes. It's pretty cool. Wrong. Only his appearance has an impact. Stop. Ricky, if inflation keeps going up, could you see a rate hike? 100%. The Federal Reserve said that they will do anything they need to control inflation. So that is not factored in already. But if we see for some apparent reason that inflation begins to go out of control, which again, that's a big what if, but it is not a possibility. They've stated that, no, it's not currently expected. But if we go from our current interest rate or our current inflation rate, what is it, like 3.7%? What did it jump to? The CPI data report, CPI, BLS.gov, what is it? The current rate's like 3.5, 3.7. I forgot what it was last time. 3.5 is currently what we sit at. So if we go from 3.5 to 4.5, something that is like out of left field, right? Something that's a complete curveball. The Federal Reserve will have no choice. The markets will drop, markets will correct themselves because they're like, dang it, things are actually getting worse. We're not even close to cutting interest rates. We're going to have to raise interest rates. But just like also right now, they just said, oh, what if we don't expect to raise interest rates or cut interest rates until November? But if next month, for some apparent reason, if we go from 3.5 to 2.5, then hey, we are working towards, inflation being under control. It's much more tamed. Maybe they could justify cutting interest rates sooner than November, right? It all goes hand in hand. Remember, the job of the Federal Reserve is to look at our inflation, to look at overall economics data, and then to determine, based off of what they believe, is the market getting close to enough, their 2% target of inflation, to then start cutting interest rates to make it more affordable for people like you and I to start borrowing money. Because remember, that's what it is. When they begin to cut interest rates, they're going to start making it more affordable for us to borrow money, for people to spend money, for businesses to spend money, and that promotes growth. It's the natural way of life, right? Of how humans react. When money is less expensive to borrow, people tend to borrow more of it. When it's more expensive, they tend to borrow less of it. It's not that they don't borrow at all. They're just a little bit more calculate, maybe a little bit more aware of the cost. And that's what I want to make you aware of. Ricky, are you long or are you short? I'm in SQQQ, which means that I'm short on the NASDAQ market. But I bought into it during this live. I don't know if you saw. I bought into it within this general area. So it pulled back a little bit. And again, just because I'm in it does not mean that you need to be. Let me make that very, very clear. I just want to see the way that the market chooses to react. Do we end up making new highs and going back up to 1230 and above? Or do we break below the moving average and begin selling off? And then at that point, I'm going to have to cut losses. Guess what? I've been wrong in the past before. My LPP team sees when I make my good trades, when I make my bad trades. But that's the beautiful part about trading. It's that we have some trolls sometimes that watch my video and they're like, haha, Ricky, you had a red day. Everyone, where is it expected that you're never going to have a red day, right? A lot of people like when I recap my red days because I like to highlight what I could have done better, and it really humanizes everything, right? And I feel like that should be the same approach for you guys. I'm not afraid to take advantage of opportunities. If I see something present itself where it meets my risk to reward ratio, I can make a few bucks and it all makes sense to me and it's calculated so I can control how much money I end up losing, then great. I'm okay with that. But you should never be afraid to take a loss, right? Our job's not to avoid risk. Our job is to manage it. So what time is Jerome Powell speaking? Jerome Powell should be speaking in the next 15 minutes. 15. This is on the 5-minute time frame. Let's see. Yeah, we can check our average purchase price right now for SQQQ. It's not. So I have about $48,000. Average purchase price is $12.10. Now 4,000 shares. Fair? Makes sense? You guys might be asking, Ricky, why do you cover it? You might be a little bit new to my live streams, so that might be a reason you don't understand why. In our LPP lesson library, I call it the blind trading challenge. Let me ask you a very simple question for those that are a little bit newer. How many times have you ever taken a trade and you end up selling a stock or buying a stock or cutting losses on a stock because of how much money you are up or down? Let me see a show of hands. Well, the reason I cover that is because the way that I like to trade is not based off of how much I'm up or down, because if you really think about it, how much I'm up or down is irrelevant to the trade opportunity. I'm the only person in the world that, based off of that entry and the current market price, that is up or down that amount. So why am I trading off of that if I'm the only one that either benefits or loses from it? It makes no sense. The trade opportunity is based off of either patterns or fundamentals or a price target, not how much I'm up or down. So obviously I still need to control and manage how much money I could potentially lose. But at that point, it should be based off of a break of pattern. So the example with this one would be is if this thing all of a sudden begins to trade below our current support range of $12, at that point, it's now doing something that it wasn't in the past before. This thing's holding above $12 a share. If it begins to sell off and begins to show signs of progress below $12, that is a break of support and that is a break of pattern, which means that my dip buy opportunity is no longer valid. The thing that I originally saw value in is no longer valid. So at that point, I can justify cutting losses. And that's the difference. I am choosing to take a trade or to cut losses, not because of how much I'm up or down, but because of the break of pattern. The value that I saw on this dip buy is no longer present. Does that make sense? Which again, you don't have to agree with me. You can continue to trade based off of how much you're up or how much you're down. But a lot of the times that leads to very impulsive and emotional decisions. And that is why I began to change that. There's a lot of the times within my LPP live sessions that I surprised myself. I thought I was up maybe like a few $100, maybe $1,000, and I end up being up, $2,000, $2,200. I think it was like just 2 days ago that happened, which is a great feeling. But again, I'm not focused on how much I'm up, or I'm not trying to watch every penny that I make on a trade. I'm trying to focus on, does it make sense to be still in this trade? That's what makes more sense to me. Because just like many of you, I also get emotional when it comes down to trading. Very simple, right? We're human. It's a natural reaction. So I view this kind of like idea of restricting my ability to see and pay attention to that to help aid my emotions. It doesn't fix it. I'm still emotional, just like you. You still have your emotions, but it just helps aid it, right? Hope that makes sense. And again, that's just one of the concepts, one of the many things that we talk about in the LPP lesson library in a little bit more detail. All right, NASDAQ market still trying to hold. Look at that. Still holding above that EMA. Where are we at with likes? All right, we have about 2,500 of you here. We have 538 likes. It looks like you guys do not want a free mouse pad. All right. I guess we'll wait till the end of the live stream. So what we're doing is I'm going to be selecting one lucky person at the end of the live stream, and we're going to do like a little poll on the live chat. And you guys are going to be getting a free mouse pad of your choice from our store at shoptechbuds.com. It could be the Elon Musk Go F Yourself, Cybertruck, Day Trader mouse pad, Don't Quit Your Daydream. Whatever it is that you like or you find as a form of motivation, you can get it for free. I'm going to be picking one of you. And again, all you literally have to do is drop a thumbs up on this video and subscribe to the channel. All right. So live stream for Fed starts in 10 minutes. That is correct. We are going to be watching it here live. Is that okay with you guys? You guys want me to stay live, right? Just 10 more minutes, and then Jerome Powell is going to be speaking, and I'll be live with you guys for another 10 to 20 minutes after that. Is that cool? Can I get a thumbs up? Dope. Did you see Starbucks and CVS? That I did. You can see on my left screen right here, right? You guys see my little recently viewed? Check this out. CVS, 18%. I'm paying attention to it. Starbucks, we actually talked about it within this live stream, 17.4%. And also for all those that are a little bit newer to our, channel, the trading application that I use is called Webull. If you ever want to check it out, I want to remind you, I don't care what you use. You can use Robinhood, you can use Ameritrade, you can use Fidelity, Charles Schwab. Great. That's great that you have your already existing trading platform. You know that you can have more than one. And if you like the way that mine looks, and if you like the way and would like to test it out, right now, Webull does have a free sign-up bonus. So if you have an initial deposit, it has to be an initial deposit of at least $5 after your account gets approved. $5, you'll earn up to 12 free shares. And all you have to do is click the 5th link in the description down below. Quick little disclaimer, the link that you use of mine does give me credit as well. So you get free shares and I get free shares, but your initial deposit has to be of at least $5. So it's a win-win for both of us if you end up wanting to use Webull. But Webull is the trading application that I use every day. And if you plan to join my LPP team, if you plan to watch me trade live and you want an application that looks just like mine, not only do I show you exactly how to set it up in the LPP lesson library, but it's the application that I use every single day. So again, it's the 5th link in the description of this video. So you can refresh your screen in the description of this video. It says earn 12 free shares, Webull. Click that link, sign up, have an initial deposit of $5, and you'll earn up to 12 free shares. But again, you have to have that initial deposit of 5 smackaroonies, $5. Smackaroonies, I don't want that to get confused. Appreciate that. Stay green. Thank you. Thank you. Ricky's a gangster. The trolls come and cry in bed on that Tesla Cybertruck. That's too funny. Yeah, when I got and I know the Tesla Cybertruck is not for everyone. I mean, obviously, even for me when I first saw it, it looked a little dingy. But when I started driving it, I fell in love with it. I think it's a really dope vehicle. Nonetheless, some people just hate Tesla, right? And I get it. It's not for everyone. But I've been having too much fun with trolls in the comment section about that Tesla Cybertruck. Here it goes, testing that same resistance. Let's see if we show signs of progress. It looks like we're testing this EMA. Do you see every single time we come back to retest? I'm looking for progress below the EMA. That would indicate more signs of some sell-in pressure, but we're not getting any of that right now. So I have to be very, very careful. Are you recovered from the last accident? Not necessarily. I can show you very, very quickly. For those that get the heebie-jeebies when they see scars, look away. But I can show you just so you guys can see. All my stitches came off, so it looks better. And it went from on this side of my hand. But it looks better. I appreciate you asking. I'm doing physical therapy twice a week. I have some of my movement back, so not all of it. But that's all I can do. That's the range of motion that I have. So it messed me up for sure. I mean, I tore a ligament, a tendon, a muscle. I cut a nerve. I have no feeling in my, my index finger. So, yeah, it was a pretty unfortunate car accident. And now I'm just working on my recovery. So for all those that are going to be asking, the lady was cited at the scene for failing to yield. No, it was not my fault. They did an internal investigation. Our insurance companies did, and they found her that she's at fault. Her insurance company took on liability, and that is all it, right? So it's unfortunate regardless. I know that it's an accident. I know that she didn't mean to, but it definitely does suck. Okay, 5 minutes left. Let me go ahead and start pulling up Jerome Powell's speech. Is that cool? All right. NASDAQ market trying to break out right before JP begins to speak. And it wouldn't really surprise me if right when he begins to speak, if we see a nice little push and then all of a sudden market begins to correct itself. But we'll see. We'll see what we get. Alrighty. So there goes. QQQ still pushing. I'm going to start. I have the live stream right here for when he starts to actually speak. We're going to turn it on over, and I'll make little comments from time to time, but just for those that are unaware of how it works, he pretty much just gives a little speech that is the same thing over and over. From all his other FOMC rate decisions, he talks about like, we're going to stay the course. Our goal is to get inflation under control. We understand the effects that it has on families. And we're doing everything in our power to, get inflation under control. So he has this little speech, and then he starts answering questions. These questions go on for about 45 minutes. I'm going to cover about 20 minutes of them. Okay. So that's going to be in the next 3 minutes. So I'm going to pull it on up. I have it here. All right. So we'll wait until he actually starts to speak, and then we'll have some fun seeing the market react. Okay? Does that sound good? I love it. All right, less than 2 minutes left, 1 minute and a half before Jerome Powell begins to speak. You guys ready? Look at that. NASDAQ trying to go break even on the day, trying to go back into the green. What do we think? Reacting in a positive way when the Federal Reserve stated that they do not expect to cut interest rates anytime soon. What a joke. All right, 1 minute left. Let me get the thumbs up. If you guys are ready for JP, hit that like button. Make sure that you subscribe to make sure that we can answer any of your questions within that live chat. Again, I really hope that you guys enjoy the little process. I'm going to put the mic over so you guys can hear him speak. And if you have any questions, just feel free to ask me in the live chat, okay? Can you guys hear that okay? Here we go. Let's see what watch Jerome Powell is wearing today. You guys ready? Let's go, let's go. And if you guys are tuning on in and you guys follow me on Instagram, feel free to tag me and I'd love to repost you guys, okay? Purple tie, please. Oh. Look at that guy to the left-hand side over here. Getting ready. There we go. JP. Let's see how the market reacts. Current NASDAQ market.
Good afternoon. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. The economy has made considerable progress toward our dual mandate objectives. Inflation has eased substantially over the past year, while the labor market has remained strong. And that's very good news. But inflation is still too high. Further progress in bringing it down is not assured, and the path forward is uncertain. We are fully committed to returning inflation to our 2% goal. Restoring price stability is essential to achieve a sustainably strong labor market that benefits all. Today, the FOMC decided to leave our policy interest rate unchanged.
Look at that.
And to continue to reduce our securities holdings, though at a slower pace. Our restrictive stance of monetary policy has been putting downward pressure on economic activity and inflation, and the risks to achieving our employment and inflation goals have moved toward better balance over the past year.
Let's see it.
However, in recent months, inflation has shown a lack of further progress toward our 2% objective, and we remain highly attentive to inflation risks. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. Although GDP growth moderated from 3.4% in the fourth quarter of last year to 1.6% in the first quarter, private domestic final purchases, which excludes inventory investment, government spending, and net exports, and usually sends a clearer signal on underlying demand, was 3.1% in the first quarter, as strong as the second half of 2023. Consumer spending has been robust over the past several quarters, even as high interest rates have weighed on housing and equipment investment. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. The labor market remains relatively tight, but supply and demand conditions have come into better balance. Payroll job gains averaged 276,000 jobs per month in the first quarter, while the unemployment rate remains low at 3.8%. Strong job creation over the past year has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years and a continued strong pace of immigration. Nominal wage growth has eased over the past year and the jobs to workers gap has narrowed, but labor demand still exceeds the supply of available workers. Inflation has eased notably over the past year, but remains above our longer run goal of 2%.
Look at this.
Total PCE prices rose 2.7% over the 12 months ending in March. Excluding the volatile food and energy categories, core PCE prices rose 2.8%. The inflation data received so far this year have been higher than expected. Although some measures of short-term inflation expectations have increased in recent months, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are strongly committed to returning inflation to our 2% objective. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue the process of significantly reducing our securities holdings, though at a slower pace. Over the past year, as labor market tightness has eased and inflation has declined, the risks to achieving our employment and inflation goals have moved toward better balance. The economic outlook is uncertain, however, and we remain highly attentive to inflation risks. We've stated that we do not expect that it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%.
Boom!
So far this year, the data have not given us that greater confidence.
Wow.
In particular, and as I noted earlier, readings on inflation have come in above expectations. It is likely that gaining such greater confidence will take longer than previously expected.
It's bad news.
We are prepared to maintain the current target range for the federal funds rate for as long as appropriate. We're also prepared to respond to an unexpected weakening in the labor market. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we've seen on inflation.
Not dropping.
At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. We will continue to make decisions meeting by meeting. Turning to our balance sheet, the committee decided at today's meeting to slow the pace of decline in our securities holdings, consistent with the plans we released previously. Specifically, the cap on Treasury redemptions will be lowered from the current $60 billion per month to $25 billion per month as of June 1. Consistent with the committee's intention to hold primarily Treasury securities in the longer run, we're leaving the cap on agency securities unchanged per month, and we will reinvest any proceeds in excess of this cap in Treasury securities. With principal payments on agency securities currently running at about $15 billion per month, total portfolio runoff will amount to roughly $40 billion per month. The decision to slow the pace of runoff does not mean that our balance sheet will ultimately shrink by less than it would otherwise, but rather allows us to approach its ultimate level more gradually. In particular, slowing the pace of runoff will help ensure a smooth transition, reducing the possibility that money markets experience stress and thereby facilitating the ongoing decline in our securities holdings that are consistent with reaching the appropriate level of ample reserves. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run.
NASDAQ market making new
To
highs.
conclude,
For
we
what?
understand that our actions affect communities, families, and businesses across the country.
What a joke.
Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thank you. Howard Schneider with Reuters. A question to follow up, if I could. Do you consider the current policy rate still, are you confident that it's sufficiently restrictive to get inflation back to 2%?
So I do think the evidence shows, pretty clearly that policy is restrictive and is weighing on demand. And there are a few places I would point to for that. You can start with the labor market. So demand is still strong, the demand side of the labor market in particular, but it's cooled from its extremely high level of a couple of years ago. And you see that in job openings. You saw it, more evidence of that today in the JOLTS report, as you'll know. It's still higher than pre-pandemic, but it has been coming down both in the Indeed report and in the JOLTS report. That's demand cooling. The same is true of quits and hiring rates, which have essentially normalized.
There it goes. New highs.
I also look at surveys of workers and, pardon me, surveys of workers and businesses and ask workers, are jobs plentiful, and ask businesses, are workers plentiful? Is it easy to find workers? And you've seen that the answers to those have come back down to pre-pandemic levels. You also see in interest-sensitive spending like housing and investment, you also see that higher interest rates are weighing on those activities. So I do think it's clear that that policy is restrictive.
Sufficiently restrictive, I guess.
So I would say that we believe it is restrictive, and we believe over time it will be sufficiently restrictive. That will be a question that the data will have to answer.
So as a follow-up, if inflation continues running roughly sideways as it has been, the job market stays reasonably strong, unemployment low, and expectations are anchored and maintained, would you disrupt that for...
Expectations are not anchored.
Or anchored.
Or anchored.
Stable, roughly. Would you disrupt that for the last half point on PCE?
I don't want to get into complicated hypotheticals, but I would say that, we're committed to retaining our current restrictive stance of policy for as long as is appropriate, and we'll do that.
Gina.
There it goes. New highs.
Thanks for taking our questions, Chair Powell. I wonder, obviously, Michelle Bowman has been saying that there is a risk that rates may need to increase further, although it's not her baseline outlook. I wonder if you see that as a risk as well, and if so, what change in conditions would merit considering raising rates at this point?
Good question.
So I think it's unlikely that the next policy rate move will be a hike. I'd say it's unlikely. Our policy focus is really what I just mentioned, which is how long to keep policy restrictive. You ask, what would it take? I think we'd need to see persuasive evidence that our policy stance is not sufficiently restrictive to bring inflation sustainably down to 2% over time. That's not what we think we're seeing, as I mentioned. But that's something like that is what it would take. We'd look at the totality of the data, answer to that question. That would include inflation expectations, and all the other data too.
What a joke.
Would that be like the acceleration in inflation?
Well, I think, again, the test, what I'm saying is if we were to come to that conclusion that policy weren't tight enough to achieve that, so it would be the totality of all the things we'd be looking at. It could be expectations, it could be a combination of things, but if we reach that conclusion and we don't see evidence supporting that conclusion, that's what it would take, I think, for us to take that step.
Chris.
Thank you, Chris Rugaber at Associated Press. You didn't mention the idea that rates are at a peak for the cycle, and didn't mention the idea that it might be appropriate to cut rates later this year, as you have at previous press conferences. So has the Fed sort of dropped its easing bias? Where are you standing on that?
So let me address cuts. So obviously our decisions that we make on our policy rate are going to depend on the incoming data, how the outlook is evolving, and the balance of risks, as always. And we'll look at the totality of the data. So I think, and we think, that policy is well positioned to address different paths that the economy might take. And we've said that we don't think it would be appropriate to dial back our restrictive policy stance until we've gained greater confidence that inflation is moving down sustainably toward 2%. So, for example, let me take a path. If we did have a path where inflation proves more persistent than expected and where the labor market remains strong, but inflation is moving sideways and we're not gaining greater confidence, well, that would be a case in which it could be appropriate to hold off on rate cuts. I think there's also other paths that the economy could take which would cause us to want to consider rate cuts, and those would be, two of those paths would be that we do gain greater confidence, as we've said, if that inflation is moving sustainably down to 2%, and another path could be, an unexpected weakening in the labor market, for example. So those are paths in which you could see us cutting rates. So I think it really will depend on the data. In terms of peak rate, I think really it's the same question. I think the data will have to answer that question for us.
Well, and could you just follow on the path where you might not cut? Is that, you mentioned that it would be inflation persistent. Is inflation, would that be the key data in making that decision, or could you expand a bit more on that? Thank you.
Again, we've set ourselves a test that for us to begin to reduce policy restriction, we'd want to be confident that inflation is moving sustainably down to 2%. And for sure, one of the things we'd be looking at is the performance of inflation. We'd also be looking at inflation expectations. We'd be looking at the whole story, but clearly incoming inflation data would be at the very heart of that decision.
Nick Timrose of the Wall Street Journal. Chair Powell, to what extent has the easing in financial conditions since November contributed to the reacceleration in growth? And do you now expect a period of sustained tighter financial conditions will be needed to resume the sort of disinflation the economy saw last year?
So I think it's hard to know that. I think we'll be able to look back, from down the road and look back and understand it better. If you look at, let's look at growth. Really, what we've seen so far this year in the first quarter is growth coming in about consistent with where it was last year. I know GDP came in lower, but you don't see an acceleration in growth. I mean, the thought would be that financial conditions loosened in December, and that caused an uptick in activity, and that caused inflation. Presumably that's or tightening in the labor market. You don't really see that happening. What you see is economic activity at a level that's roughly the same as last year. So, what's causing this inflation, we'll have a better sense of that over time. I don't know that there's an obvious connection there, though, with the easing of financial conditions. In terms of tightening, you're right. I mean, rates are certainly higher now and have been for some time than they were before the December meeting, and they're higher, and that's tighter financial conditions, and that's appropriate given what inflation has done in the first quarter.
You've said in the past that stronger growth wouldn't necessarily preclude rate cuts. I wonder, would continued strength in the labor market change your view about the appropriate stance of policy if it was accompanied by signs that wage growth was reaccelerating?
So I just want to be careful that we don't target wage growth or the labor market. And remember what we saw last year: very strong growth, a really tight labor market, and a historically fast decline in inflation. So and that's because we know there are two forces at work here. There's the unwinding of the pandemic-related supply side distortions and demand side distortions, and there's also monetary policy, restrictive monetary policy. So I wouldn't rule out that something like that can't continue. I wouldn't give up at this point on further things happening on the supply side, either because we do see that companies still report that there are supply side issues that they're facing, and also even when the supply side issues are solved, it should take some time for that to affect economic activity and ultimately inflation. So there are still those things. So I don't like to say that either growth or a strong labor market in and of itself would automatically create problems on inflation, because of course it didn't do that last year. You ask about wages. We also don't target wages. We target price inflation. It is one of the inputs. The point with wages is, of course, we like everyone else like to see high wages, but we also want to see them not eaten up by high inflation, and that's really what we're trying to do is to cool the economy and work with what's happening on the supply side to bring the economy back to 2% inflation. And part of that will probably be having wage increases move down incrementally toward levels that are more sustainable.
Rachel.
Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. You talked about needing time to gain more confidence that inflation is sustainably moving back down to 2%. It's May now. Do you have time this year to cut 3 times, just given the calendar?
Yeah, I'm not really thinking of it that way. You know, what we said is that we need to be more confident, and we've said, my colleagues and I today said that we didn't see progress in the first quarter, and I've said that it appears then that it's going to take longer for us to reach that point of confidence. So I don't know how long it'll take. I can just say that when we get that confidence, then rate cuts will be in scope, and I don't know exactly when that will be.
And with hindsight, are there any signs that you can look back on now, looking at the reports from January or February or March, that suggested something more worrying than just expected bumpiness?
Not really. So I thought it was appropriate to reserve judgment until we had the full quarter's data, until we saw the March data. And so take a step back. What do we now see in the first quarter? We see strong economic activity. We see a strong labor market, and we see inflation. We see 3 inflation readings. So I think you're at a point there where you should take some signal. We don't like to react to 1 or 2 months data, but this is a full quarter, and I think it's appropriate to take signal now, and we are taking signal. And the signal that we're taking is that it's likely to take longer for us to gain confidence that we are on a sustainable path than a 2% inflation. That's the signal that we're taking.
What in the world?
Mr. Chair, if I could, Steve Leisman, CNBC, if I could follow up on that. What particular areas were sort of temporary or blips in the inflation data in the first quarter? And what's the dynamic by which you expect them to work out in the coming months and quarters?
Yeah. So we will, we will put the thing, we have put the thing under a microscope. I will say nothing is going to come out of that that's going to change the view. I think that, in fact, we didn't gain confidence, and that it's going to take longer to get that confidence. But confidence, I just think, you know the story. What's happened since December is you've seen higher goods inflation than expected, and you've seen higher non-housing services inflation than expected, and those two are working together to sort of be higher than we had thought. And there are stories behind how that happened. I think my expectation is that we will, over the course of this year, see inflation move back down. That's my forecast. I think my confidence in that is lower than it was because of the data that we've seen. So we're looking at those things. We also continue to expect, and I continue to expect.
How is any of that good news?
Given where market rents are, those will show up in measured housing services inflation over time. We believe that it will. It looks like that there are substantial lags between when lower market rates turned up and for new tenants, and when it shows up for existing tenants or for in-housing services. So,
if I could just follow up, is there a bit of a contradiction in the idea that you are reducing quantitative tightening, which is sort of an easing, while you're holding rates steady at a restrictive rate to try to slow and cool the economy and inflation? Thank you.
No, I wouldn't say that, no. I mean, the active tool of monetary policy is, of course, interest rates. And this is a plan we've long had in place to slow, really not in order to provide accommodation to the economy, but to be less restrictive to the economy. It really is to ensure that the process of shrinking the balance sheet down to where we want to get it is a smooth one and doesn't wind up with financial market turmoil the way it did the last time we did this, and the only other time we've ever done this.
Craig.
Torres from Bloomberg. 2 questions. First, simple one. Given the run of data since March, has the probability in your mind of no cuts this year increased or stayed the same? That's the first question. Second question. Chair Powell, you joined the board in 2012, and I'm sure you remember, as I do, what the jobless recovery was like. Lawyers, accountants, all kinds of highly qualified people who couldn't get jobs. And given your history there, I wonder if there's an argument for being more patient with inflation here. We have strong productivity growth. That's helping wages go up. We have good employment. And so it seems to me there's a lot of hysteria about inflation. I agree, it's, nobody likes it, but is there an argument for being patient and working with the economic cycle to get it down over time? Thank you.
So on your first question, I don't have a probability estimate for you, but all I can say is that, we've said that we didn't think it'd be appropriate to cut until we were more confident that inflation was moving sustainably on at 2%. We didn't get, our confidence in that didn't increase in the first quarter, and in fact, what really happened was we came to the view that it will take longer to get that confidence. And I think I think it's, the economy has been very hard for forecasters broadly to predict its path, but there are paths to not cutting, and there are paths to cutting. It's really going to depend on the data. In terms of the employment mandate, to your point, if you go back a couple of years, our sort of framework document says that when you look at the two mandate goals, and if one of them's further away from goal than the other, then you focus on that one. It's the time to get back there times the times how far it is from the goal, and that was clearly inflation. So our focus was very much on inflation. And this is what we referred to in the statement. As inflation has come down now to below 3% on a 12-month basis, it's become we're now focusing the other goal, the employment goal, now comes back in to focus, and so we are focusing on it, and that's how we think about that.
Claire.
Claire Jones, Financial Times. Thanks a lot for the opportunity to ask the questions. Just to go back to the answer before the previous one, it seemed to suggest that you think the likeliest path of inflation is one that's going to allow you to have a situation where rates are lower at the end of the year than they are right now. It'd be good if you could just confirm whether or not that's a correct reading. And the Q1 GDP print has led to some to start mentioning the term stagflation with respect to the US economy. Do you or anyone else on the FOMC think this is now a risk? Thank you.
Yeah, I'm not dealing really in likelihoods. I think there are
Watch for signs of resistance on the NASDAQ market. Just a quick little heads up.
Cuts in their paths that wouldn't, and I don't have great confidence in which of those paths. I think I would say my personal forecast is that we will begin to see further progress on inflation this year. I don't know that it will be sufficient. I don't know that it won't. I think we're going to have to let the data lead us on that. In terms of your second question was stagflation. I guess I would say I was around for stagflation, and it was 10% unemployment. It was high single digits inflation. Right now we have and very slow growth. So right now we have 3% growth, which is pretty solid growth, I would say, by any measure, and we have inflation running under 3%. So I don't really understand where that's coming from. And in addition, I would say, most forecasters, including our forecasting, was that last year's level of growth was very high, 3.4% in, I guess, the fourth quarter, and probably not going to be sustained and would come down. But that would be our forecast. That wouldn't be stagflation. That would still be to a very healthy level of growth. And of course, with inflation, we will return inflation to 2%, and that won't be. So I don't see the stag or the inflation, actually.
Michael McKee from Bloomberg Radio and Television. The vice chair of the FOMC said recently that he's willing to consider the idea that potential growth has moved up, and of course he's Mr. Potential Growth, our star. Do you share that view, and would that imply that maybe policy isn't tight enough?
I think I would take that question this way. We saw a year of very high productivity growth in 2023. And we saw a year of, I think, negative productivity growth in 2022. So I think it's hard to draw from the data. I mean, the question is, will productivity run? There are two questions. One is, will productivity run, persistently above its longer run trend? I don't think we know that. In terms of potential output, though, if that's a separate question. We've had what amounts to a significant increase in the potential output of the economy that's not about productivity. It was about having more labor, frankly, both through, in 2023, both through participation and also through immigration. So we're very much like other forecasters and economists getting our arms around what that means for potential output this year and next year and last year for that matter too. So I think in that case, I think you really do have a significant increase in potential output, but you've also got so you got more supply, but those people also come in. They work. They have jobs. They spend. So you've also got demand. So it may be that you get more supply than you get demand at the beginning, but ultimately it should be neither inflationary nor disinflationary over a longer period.
Well, you said earlier that at this point you're not really considering rate increases if growth is higher, but you're not considering rate increases. Does that imply that you're more worried about causing the economy to slow too much than you are about inflation taking off again?
No, I think we believe our policy stance is in a good place and is appropriate to the current situation.
Look at that.
We believe it's restrictive, and our evidence for that I went over earlier. You see it in the labor market, you see it in inflation-sensitive spending, where demand has clearly come down a lot over the past few years, and that's more from monetary policy, whereas the supply side things that are happening are more on the supply side. So that's how I would think about it.
Edward.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. So GDP growth is about 2%. Inflation, employment is about 4%. It feels a lot like a steady state, and we have 3% inflation. So if the data remains the same that you're seeing, and I know you said you don't see a rate hike, but it stands to reason that you would need a rate hike to get from 3 to 2% inflation. So was there any discussion about a rate hike in today's meeting? And are you satisfied with 3% inflation for the rest of the year?
Well, of course, we're not satisfied with 3% inflation. 3% can't be in a sentence with satisfied. So we will return inflation to 2% over time, but over time. And we think our policy stance is appropriate to do that. So if we were to conclude that policy is not sufficiently restrictive to bring inflation sustainably down to 2%, then that would be what it would take for us to want to increase rates. We don't see that. We don't see evidence for that. So that's where we are.
Was there a discussion about a rate hike at all?
So the policy focus has really been on what to do about holding the current level of restriction. That's part of the policy. That's where the policy discussion was in the meeting.
Yeah, I wanted to follow on the 3%. Is there a time frame of persistent inflation that would trigger a rate hike?
There isn't any rule. You can't look to a rule. These are going to be judgment calls. Clearly, restrictive monetary policy needs more time to do its job. That is pretty clear based on what we're seeing. How long that will take and how patient we should be, it's going to depend on the totality of the data, how the outlook evolves.
Victoria.
Hi, Victoria Guido with Politico. You've talked about your commitment to being apolitical and nonpartisan, and I was just wondering, given that it's an election year, is the bar for rate changes higher close to an election? And similarly, is there a significant economic difference between starting to cut in, say, September versus December?
So we're always going to do what we think the right thing for the economy is when we come to that consensus view that it's the right thing to do for the economy. That's our record. That's what we do. We're not looking at anything else. You know, it's hard enough to get the economics right here. These are difficult things, and if we were to take on a whole nother set of factors and use that as a new filter, it would reduce the likelihood we'd actually get the economics right. So that's how we think about it around here. And you know, we're at peace over it. We know that we'll do what we think is the right thing when we think it's the right thing, and we'll all do that. And that's how everybody around here thinks. So I can't say it enough that we just don't go down that road. If you go down that road, where do you stop? And we're not on that road. We're on the road where we're serving all the American people and making our decisions based on the data and how those data affect the outlook and the balance of risks.
And then is there a significant difference between, whether you start in, say, September versus December?
There's a significant difference between an institution that takes into account all sorts of political events and one that doesn't. That's where the significant difference is. And you know, we just don't do that. I mean, you can go back and read the transcripts for this is my fourth presidential election here. Read all the transcripts and see if anybody mentions in any way the pending election. It just isn't part of our thinking. It's not what we're hired to do. If we start down that road, I don't know how you stop. So.
Thank you, Chair Powell. Question about the labor market. You've mentioned a few times that the labor market is normalizing. Certainly today's JOLTS data suggested that things are kind of getting back to pre-pandemic levels. One thing that hasn't normalized is wage growth, which is still quite a bit stronger than before the pandemic. I wonder if you can share your analysis of why that's happening. Is it a lagging indicator or something else going on?
So I think if you go back to where wages peaked, wage increases peaked a couple, 3 years ago, essentially all wage measures have come down substantially to that. But they are not down to where they were before the pandemic. They're still roughly a percentage point higher. And we've seen pretty consistent progress, but not uniformly. And you'll note the ECI reading from Tuesday was expected to have come down, and essentially it was flat year over year, I think, roughly. So, yeah, I mean, that part of it is bumpy. And again, we don't target wage increases, but in the longer run, if you have wage increases running higher than productivity would warrant, and then there will be inflationary pressures. Employers will raise prices over time if that's the case. So we've seen progress. It has been inconsistent, but we have seen a substantial decline overall. But we have ways to go on that.
Scott. 2 words. Nancy. Sorry.
Hey, Chair Powell, Nancy Marshall-Genser from Marketplace. You mentioned consumers, and consumers are feeling the weight of interest rates right now. Mortgage rates are up, as are rates for car loans, credit cards. People looking to borrow are very discouraged. That's reflected in their views on the economy. What would you say to them?
Well, the thing that hurts everybody, and particularly people in the lower income brackets, is inflation. If you're a person who's living paycheck to paycheck and suddenly all the things you buy, the fundamentals of life go up in price, you are in trouble right away. And so with those people in mind in particular, what we're doing is we're using our tools to bring down inflation. It will take some time, but we will succeed, and we will bring inflation back down to 2%, and then people won't have to worry about it again. That's what we're doing, and we know that it's painful and inconvenient, but the dividends will be paid will be very large, and everyone will share in those dividends. And we've made quite a lot of progress if you can think about it. I think headline core PCE peaked at 5.8. Now it's at, anyway, headline peaked at 7.1. Now it's at 2.7. Don't want to get that wrong.
No, you don't. Quick follow-up. Are current interest rates really doing that much, though, to fight inflation right now for those consumers?
Yes, I mean, I think that restrictive monetary policy is doing what it's supposed to do, and but it's also in this case unusually working alongside and with the healing of the supply side. That was different this time was that a big part of the source of the inflation and the reason why we're having this conversation is that we had this supply side kind of collapse with shortages and bottlenecks and all that kind of thing. And this was to do with the shutting down and reopening of the economy and other things that really raised demand. So many factors did that. So I think now you see those two things working together, the reversal of those supply and demand distortions from the pandemic and the response to it, along with restrictive monetary policy. Those two things are working to bring down inflation, and we've made a lot of progress. Let's remember how far we've come. And we have a ways to go. We've got work left to do, but we're not looking at the very high inflation rates that we were seeing 2 years ago.
Courtney Brown from Axios. Thanks for taking our questions, Chair Powell. I wanted to follow up on something you mentioned earlier on housing inflation. There's kind of been this long-awaited disinflation in shelter that still hasn't arrived. So I guess two questions. How do you explain the substantial lags between some of the private sector data we're seeing and the government data? And how confident are you that rents will be helpful on the inflation front in the coming months?
So
I just took off my stitches.
There are a number of places in the economy where there are just lag structures built into the inflation process, and housing is one of them. So when you have when someone a new person goes to rent an apartment, that's called market rent, and you can see market rents are barely going up at all. The inflation in those has been very low. But it takes, before that, they were incredibly high. They sort of led the high part. So what happens is those market rents take years, actually, to get all the way into rents for tenants who are rolling over their leases. Landlords don't tend to charge as much of an increase to a rollover tenant for whatever reason. And what that does is it builds up a sort of an unrealized portion of increases when there have been big increases. And what happens is, and it's complicated, but the story is it just takes some time for that to get in. Now, I am confident that as long as market rents remain low, this is going to show up in measured inflation, assuming that market rents do remain low. What will be the exact timing of it? I think we've learned that the lags are longer. We now think significantly longer than we thought at the beginning. And so confident that it will come, but not so confident in the timing of it. But yes, I expected that this will happen.
Thanks.
Nick Jasinski.
Thank you, Chair Powell, for taking the questions. This is Nicholas Jasinski from Barron's Magazine. It seems that over the past 3 or 4 years, economies and central banks in developed markets at least have been on more or less the same trajectory, easing during the pandemic, fighting inflation with restrictive policy on the way out. Feels like that may be ending in 2024 based on some of the economic data from Europe and the US and Japan and statements from those central banks as well. So my question is, what considerations or risks does a period of more divergent global economic trajectories and central bank policies present for the FOMC?
So you're right. I think that may happen, and you know that we all serve domestic mandates, right? So I think the difference between the United States and other countries that are now considering rate cuts is that they're just not having the kind of growth we're having. Their inflation is performing about like ours or maybe a little better, but they're not experiencing the kind of growth we're experiencing. So we actually have the luxury of having strong growth and a strong labor market, very low unemployment, high job creation, and all of that. And we can be patient, and we'll be careful and cautious as we approach the decision to cut rates, whereas I think other jurisdictions may go before that. In terms of the implications, I think obviously markets see it coming. It's priced in now, and so I think the markets and economies can adapt to it. And I think we haven't seen, in addition for the emerging market economies, we haven't seen the kind of turmoil that was more frequent 20 years ago, 30 years ago. And that's, I think, partly because emerging market countries, many of them have much better monetary policy frameworks, much more credibility on inflation. And so they're navigating this pretty well this time.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You sort of backed away from the notion that the economy would need to encounter pain for inflation to come back down. But given sticky inflation data in the first quarter, can disinflation still happen along a relatively painless path for the economy, or is some softening in the labor market and the economy likely needed to bring inflation back down?
So you're right. I think we thought, and most people thought there would have to be probably significant dislocations somewhere in the economy, perhaps the labor market, to get inflation all the way down from the very high levels it was at the beginning of this episode. That didn't happen. That's a tremendous result. We're very, of course, gratified and pleased that hasn't happened. And if you look at the dynamics that enabled that, it really was that so much of the gain was from the unwinding of things that weren't to do with monetary policy, but the unwinding of the distortions to the economy, supply side problems, and also some demand issues as well. The unwinding of those really helped inflation come down. Now, as I've said, I'm not giving up on that. So I think it is possible that those forces will still work to help us bring inflation down. We can't be guaranteed that that's true, though. And so we're trying to use our tools in a way that keeps the labor market strong and the economy strong, but also helps bring inflation back down to 2% sustainably. We will bring inflation down to 2% sustainably. We hope we can do it without significant dislocations in the labor market or elsewhere.
And speaking of dislocations in the labor market, in terms of cutting, you said if there were weakness in the job market, that could be a reason to cut rates. So if the unemployment rate were to tick above 4%, but inflation not back down to your 2% target, how would you look at that? Would the unemployment rate popping back above 4% catch your attention?
I said an unexpected weakening is the way I characterize it. So, and I'm not going to try to define exactly what I mean by that, but it'd have to be meaningful and get our attention and lead us to think that the labor market was really significantly weakening for us to want to react to it. A couple of tenths in the unemployment rate would probably not do that, but it would be a broader thing that would suggest that it would be appropriate to consider cutting. And I think whether you decide to cut will depend on all the facts and circumstances, not just that one.
Chair Powell, thanks for taking the question. Kyle Campbell with American Banker. You've said that broad and material changes are needed for the Basel III endgame proposal, and you've mentioned that reproposal is something that's on the table. As you've had more time to sort of sit with the public commentary, process that, and understand.
I don't know if it's just me, but I feel like Jerome Powell is dancing around questions more than he normally does. I mean, obviously he doesn't want to give too much. I 100% get it. I don't care for this question. If you guys want to continue to watch this live stream of Jerome Powell and answering these questions, again, it should be available under the Federal Reserve website, so feel free to check it out. As of right now, NASDAQ market looks incredibly bullish. It is not pulling on back. This is QQQ, which is the 1-for-1 NASDAQ ETF. It just continues and continues to make like steady and slow progress. I think it's extremely overbought. I still have my short position open. It's about $48,000 that I'm shorting the NASDAQ with, and I want to go in. And again, it's just me. I don't want to say I want to go in. If I get confirmation that NASDAQ begins to break below the EMA and actually begin to indicate signs of progress on the downside, so pretty much just confirming a reversal that it's getting rejected and selling off, I will quadruple my position. So I'll go in with 50 instead of 50,000 shares. I'm going to go in with 200,000. I'm sorry, not 50,000 shares. Instead of $50,000 or $48,000, I'm going to go in with $200,000, shorting the NASDAQ market, which should make it quite easy to make money if I actually get progress of this thing pulling on back and making lower lows and lower highs. If, that is the big thing. If. The whole point of keeping a light position size is to be able to tolerate worst case scenario. This is a pretty dramatic reaction. Again, I want to recap this very, very quickly. You guys can feel free to gather your own opinions and your own thoughts. The first thing is the Federal Reserve decided to pause interest rates today. Surprise, surprise. Everyone knew that was most likely going to happen. Not much of a surprise there. The second thing is that Jerome Powell in this meeting seemed more hawkish, which means that They are nowhere close to cutting interest rates than any other FOMC meeting that I've seen this year so far. Yet, the market is reacting in a positive way. And remember, we cannot control how the market reacts, but yet the market is reacting in a positive way, even when the Federal Reserve said we might not even cut interest rates until later this year. We do not like how inflation data is being reported. We do not see inflation working towards our price target of 2%. And market's like, okay, bullish, buy. Nonetheless, that's how the market is reacting. And trust me, I get it. It's frustrating. Control your emotions, right? Don't add more money into it if direction is not in your favor. Don't make it about you. Again, no one cares about me. No one cares about you. It's not about that. It's not personal. Let's wait for the trade opportunity. Stay calculated and try to minimize the amount of emotions and how impulsive you end up being with the trades you choose to take. Because guess what? Although we might want the market to pull on back because that's how we interpreted this FOMC rate decision, guess what? The market can continue to go higher for longer. And I want to remind you of that. Do not put yourself in a worse position by adding more size to something that is not going according to plan. Now, if this thing begins to confirm the reversal, then yes, I can justify adding more because then at that point, direction is in my favor and I can really work with the market. Now I have more margin to work with if it sells off. But guess what? We don't have that confirmation yet. So even though I want to, I really want to, but guess what? It doesn't matter what I want. It doesn't matter what you want. Let's wait for that trade opportunity to present itself and let's stay calculated. Let's do what we weren't doing before, and that's planning out our actual trade. I've said it so many times before. Again, we have our risk to reward ratio calculator. It's a free little Excel sheet that really just helps you plan out your next trades, your entry, your exit, your cut losses, and then it explains your risk to reward ratio, how many shares, your buying power, and how much you could potentially win and how much you could potentially lose. This is the beauty about planning out your trades. And again, it's all available at techbutsolutions.com or the first link in the description of this live stream. You should be able to see it. It will take you to this website. It's under trading tools. And again, you can download it under numbers for Apple devices or for PCs under Excel. I appreciate your time. I hope that we earned your thumbs up. And guess what? It looks like we might be getting the confirmation of reversal, but please remember, control those emotions. Stay calculated. Be effective with the time that you actually spend in the market and how much money you pour into it. Make it make sense to you. Don't do it emotionally. Do it in a calculated way. So I really do appreciate you guys this time. I hope that we earned a thumbs up. And very quickly, I owe one of you guys a mouse pad. So let's do it. I'm going to pick someone in the live chat as a winner for our mouse pad. So let me know in the live chat what mouse pad you want from our site. Just type it in. Make sure you copy it and keep pasting it. Let me know in the live chat and I'll pick one winner and then we'll go from there, right? We'll reach out to you and we'll go from there. So other than that, I do want to remind you, I do trade live every single morning. You're more than welcome to tune on in to our live trading sessions as soon as tomorrow. And that's going to be that second link in the description down below. It's our LPP. It's our daily live trading session. And please make sure that if you're someone new, I would love to have you for our live session. And that's that second link in the description down below. So without further ado, I'm going to go ahead and I'm going to bring this over here. And all I'm going to do is I'm going to screenshot a random winner. So for those that are not able to type in the live chat, you do have to be subscribed to the YouTube channel. Again, I don't mind giving these away. All I ask you is if you support me, I'll support you. Drop a thumbs up, subscribe to the channel, and turn on your post notifications, okay? So I'm gonna do a 10-second countdown, and then I'm just gonna screenshot a random comment, okay? So I'm gonna do it here. Is that fair? I'm gonna look away. Ready? Countdown. I'm gonna count from 10. 10, 9, 8, 7, 6, 5, 4, 3, 2, 1, boom. All right. John Mason. John Mason is asking for the Elon Musk mouse pad. So if I'm not mistaken, it's going to be this one, the one that says "Go F Yourself." We have it available at shoptechbuds.com. And again, we have a bunch of different mouse pads, day trader mouse pads, all of these good things. Again, if you ever want a discount, just shoot me a DM via Instagram. Would love to hook you up with a discount. So John Mason, just send me a direct message via Instagram. Again, my Instagram is linked in the description of this video. Show me that this is your account. Show me that you have access to it. Show me that that is what you commented, and I'll go ahead and I'll send you a coupon code so you can get a mouse pad for free, that Elon Musk mouse pad, and we'll send it right to your doorstep. So I appreciate you guys tuning on in. Hopefully you guys can congratulate John, and yep, that's pretty much it. I will see you at Market Open for our live trading session. And remember, it's designed for complete beginners. So if you want the ability to watch me trade live every single day, second link in the description down below, 50% off. It's a one-time payment, lifetime access. And yes, it's lifetime access. You get to watch me trade live every freaking day. And what better way to start the month of May to be able to start watching these live sessions, especially if you feel like trading is lonely or you're just getting started. I appreciate your time. Hope that we're into thumbs up. Please consider subscribing. And like always, let's make sure that we end the year